Hello, Gary. How are you?
Yeah, good. Thanks, Leo. How are you?
Yeah, I'm very well, thanks. I've got a few questions for you today, Gary. I'd like to ask you about the pandemic. We've got the rising stock markets, rising unemployment numbers, along with the government's furlough scheme. Then I'd like to touch on the fact that the UK's got less than 6 months now to reach a deal with the EU around Brexit. So, if I start with the pandemic, markets have made an impressive recovery since those painful lows in March. I understand that we expect volatility to continue. Hopefully, though, we're getting back on track. Now, we also know the pandemic caused a massive hit to the global markets. But was this a pure COVID crash, or did it expose weaknesses that already existed and push them over the brink?
Well, markets hate uncertainty. And so when the coronavirus first came about, there was huge uncertainty in terms of what its real impact would be on the global economy and therefore what its impact would be on company profits. And the worst situation for markets is when they can't work out what's going to happen. And generally, when that occurs, they work out the worst scenario and factor it into prices. Now, if you think back to the start of March 2020, March this year, there was huge talk about what the potential death rate could be in this country. I wrote a piece and said, if it really is like the Spanish flu of 1918, then if we adopt a laissez-faire attitude, no intervention, you potentially risk deaths the size of Birmingham. 2.5 million, more than the size of Birmingham. Now you can imagine what markets think about that. But as things have moved on, what has become clear is that despite the fact that, the leading epidemiologist in this country, Neil Ferguson, likened COVID-19 to the Spanish flu at the start of March, despite that, it's not anything like Spanish flu. The death rate's nowhere near as bad. And the figures are improving. Infections are improving and the number of deaths are coming down. Now, the market will look at that and factor in and say, okay, we've taken a big hit. How quickly can we come out the other side of it? Now, let me explain a little bit around that. You own a company and it's producing a certain amount of profit and you're going to keep it for quite a long period. Warren Buffett always says the optimal holding period is forever. And I think if you think of stocks like that, you make less mistakes in your selection process. But you're looking to hold this company perhaps for decades. You really don't know. And you have a wobble in 2020 through COVID, and it knocks a quarter or two's profits right down or even takes that business into losses, and it stops paying its dividend. But that's one little blip on a 20-year journey. What really matters is what will that company do the other side of the pandemic. And I think what markets began to do was factor in that a recovery will be okay and that the authorities will respond to try and help their economies, which is actually exactly what has happened. So I don't think we should be surprised with what happened to markets, because the truth is that this pandemic has been a lot better than potentially it could have been.
Sure. Thanks, Gary. So the recent market rally that we've seen, to what extent is this due to the extreme quantitative easing measures that are being used by the central banks? And if any, should we be wary of this increasing divergence between the stock markets and the state of the real UK economy?
Well, quantitative easing has been really the only tool that governments have used post the global financial crisis of 2008-2009. I think when we look back in history, we're quite judgmental about our ancestors and we see that they got things spectacularly wrong. Early 1930s, tightening of monetary policy caused depression in the States, and no doubt the politicians wanted to do it differently in post the 2008 global financial crisis. So what they did, they used quantitative easing, which is lowering interest rates, buying up bonds, keeping long-term interest rates down to keep the money supply flowing. And they've been doing that for 12 years. The problem is it's not really got the economy going. And I'm afraid governments around the world have become a bit of a one-trick pony. All they respond with is quantitative easing. So yes, along comes another batch of quantitative easing, which I guess one would expect into a pandemic. And yes, the market's responding positively to it. I don't think that was the main reasons that markets responded. I think the main reasons that markets responded is they began to work out that this wasn't the Armageddon scenario that it perhaps looked like at the start of March. But quantitative easing definitely helped. However, quantitative easing wouldn't have been any good to help workers losing their jobs through the lockdown. And so what's interesting this time round is you've seen the government respond with strong fiscal policy. In other words, the UK government hasn't said to the Bank of England, the pandemic and the economy, that's your problem. Quantitative easing can solve it. No, what the government have done is responded and said, we'll have to do some spending too. And I'm hoping that in the next decade, the government will come to the party with better fiscal policy and not leave the job of stimulating the economy to the Bank of England.
Gary, thanks. Unemployment is rising rapidly in the UK. What do you estimate the unemployment figure will be come October when the government's furlough scheme reaches its end?
Yeah, so what you mean is people out of work, furloughed or unemployed, is rising rapidly because the UK unemployment rate isn't rising anything as rapidly as happening in the States where they haven't got our furlough system. So to give you an idea, the unemployment in the States around 4% before we hit this crisis, shot up to 14.7%. But the last jobs figures in the US were encouraging. Unemployment's dropped sort of back down to 13%. But anybody watching this, can I also remind them that whilst we may look at those levels of disastrous unemployment, the Greeks have only just got back down to it. You know, their economy has been in a terrible state for 12 years or so. And we are coming off the back of record low unemployment figures, and that helps. So my guess is that, and this really is a guess, is that what you've seen in the US is the extent to which the unemployment is true. In other words, it shot up to 14.7% very rapidly as the lockdown came. Ours won't get to that level because of furloughing. But once furloughing comes to an end, I think it's inevitable that some companies are going to shed jobs. Not everything will get back to normal the way it was back in February. It's clearly not going to be like that now. But that in itself is not a bad thing in the long term, because if the coronavirus pandemic takes out some zombie companies that have been sitting on large amounts of capital but not being particularly productive, and their assets get used by more productive businesses, then the economy will grow faster and we'll get some increase in productivity. So I'm reasonably optimistic, and I'm trying desperately not to give you an actual figure because I know if I do, I'll get hung on it. However, if you want me to have a guess at it, I'd say unemployment is probably going to double, perhaps up to about 8%, and then it may start to slip back down again, depending on what the government does with its fiscal policy once the pandemic is over.
Okay, so how much do you think the furlough scheme might cost the government in total?
Quite a lot of money, but perhaps not as much as some people think. The Office of Budget Responsibility thinks it's going to cost the government about 60 billion this year. Put that in context, that's about 3% of GDP. Not that bad, really. And if it does the job, I think what we need to get away from is looking at the short-term costs. I think what you've got to look at here is what is the longer-term implication. You know, 60, 120 million, a billion, 200 billion isn't bad necessarily. You know, sticking an extra 10% of borrowing onto the government's books because of its response to this pandemic isn't a bad thing if the post-pandemic economy improves. And I think that's what's going to be the acid test. What will the economy look like when we get out the other side of this COVID-19 lockdown? Will it come back, and will we then get a return to productivity? if we get a return to improvements in productivity, then the 60 billion that the OBR estimates it would have cost the government for the furloughing scheme will be a drop in the ocean. And we'll all wonder why we didn't get involved in more fiscal policy after the global financial crisis, where we may be in a much better state than we're in today.
Gary, 60 billion. Is this the biggest form of employment benefit ever paid out by a UK government?
I know who put you up to asking that question, Leo, interestingly. So
No
I can't be certain about it, because it depends on how you look at the way in which government supported unemployment in the past. Because at one stage we were getting unemployment down by simply having everybody employed in state-owned industries that became hopelessly uncompetitive. I mean, that was what we would look like in the early 70s. So unemployment was very low in 1973, but look what happened afterwards. But my simple answer is yes, it probably is the biggest ever one-off engagement by a government to support unemployment. And I take my hat off to Rishi Sunak for this innovation, because he has tried to keep employees connected to their employers so that they naturally come back to work in their old jobs once lockdown finishes. If that relationship had been severed, I think the unemployment position would have been baked in a lot worse than it's going to be due to the government's policies.
Makes sense, Gary, thanks. On the pandemic again, just thoughts on a second wave. If lockdown eases, have you got any contingencies in place for a potential second lockdown? Any idea what it might look like if we end up there?
Well, the normal contingencies are in place that we've always got. Try and find strong assets, try and find strong companies, check the balance sheets. You know that some companies are going to get hit with things that come along that nobody foresees, like COVID-19. But you want them to survive. You don't want to be investing in companies that become very illiquid and go bust. So we are always mindful of what might happen in the markets and the effect the economy may have on the things that we own. And we always try and make sure that these things are likely to survive for 10, 20 years. But we've always done things like that. And at my age, the words, people kept using this phrase, unprecedented when this coronavirus problem started. Unprecedented. It is not unprecedented. There is stacks of precedent. It may look slightly different to previous pandemics, but it's a lot better than the Black Death, a lot better than the Spanish flu of 1918, perhaps a bit worse than 57 and 67 on those pandemics. You have to be mindful when you are an investment manager that you just do not know what's going to happen. And if you hold that mindset, you are more careful with where you put your clients' assets. And so we would always be like that. But the honest answer is, I think we seem to be a bit more fully invested than our peer group, because we've done a lot better through the recovery than a lot of our peer groups. So relative results are very strong from Courtiers funds recently, which is great. But we are not, we've got some dry gunpowder in the form of cash in treasury bills. And if we wanted to be more aggressive today, we could be, but we're not going to be. We're just going to try and be sensible and plot our way through this. So this is not, in our view, a time to try and shoot the lights out as we thought it was in March 2009 on the back of the global financial crisis. And that summer we had a blinding recovery, but we're just trying to be sensible. One thing I would mention to people is you have to look at this is, everybody likes to look at stock markets. They could do this, they could do that. Be very careful of bonds, which are hellishly expensive at the moment. And also bear in mind that if you are an investor right now and you've got to put away money for 10, 20 years, where are you going to put it? If you put it in a 10-year government bond, you're not going to get much more than 0.3% per annum. If you put it in cash, you're getting virtually nothing. If you buy a property, you've got to get it let, and then you don't know where property prices are going to go. Stock market doesn't look too bad when companies are cash generative. They're seeing their way through and they're still making some profits. So I think that this is not a bad situation for taking a 10-year view, but do I think that the market's going to rocket 20% the next year? Probably not. Do I think it's going down 20%? Probably not. And we're trying to be mindful about that and just be sensible with it and be aware of all risks. So my answer to your question is, yes, we're concerned about the effects of the economy. Of course we are, but we're concerned about it all the time. And I think that's the knack of good investment management, is to keep looking at the risks and think about the things that you haven't seen yet. We're not talking about world trade problems at the moment. That's going to be a dramatic change. Productivity issues existed before COVID-19 came along. So we have to be mindful of all those as well as coronavirus.
Keeping a level head.
Trying to, Leo, trying to.
Planning for different scenarios takes us nicely onto our last subject, Brexit. Now, the government's expected to tell the EU this Friday that it will not seek an extension to Brexit. That gives us less than 6 months to strike a deal. Now, when questioned, the MP and Paymaster Penny Mordaunt told the House of Commons, quote, "It would be prudent and wise for us to prepare for every scenario." Now, first of all, what is every scenario? And we can perhaps look more at every scenario later. But what I'm interested in at the moment is, how is Courtiers planning for a potential no-deal Brexit? What impact might that have on investments and markets?
Well, I don't think you'll get a no-deal Brexit, first off. I don't think it doesn't make sense for our European colleagues or us to go into a no-deal. We're a trading nation, so is the rest of Europe. We should try and find a way in which we can trade together. But of course, I think where this government, because it was voted in with an 80-seat majority, and it is a government that is committed to coming out of the European Union. And just in case anybody watching this thing thinks that I am a hardened Eurosceptic, I'm not. I voted Remain in 2016, as I keep reminding people, because I think that you can't go into a negotiation with the other side thinking that you won't walk away from the table. You can't send somebody in to do a deal and say, you must get a deal, and then tell the other side that the person they're negotiating with can't walk away because they've been told they've got to do a deal. And this was the nonsense that was going around in Parliament when we were trying to get to the end of Brexit and get some agreement to come out. So I think we will go on about walking away from the table, and just to answer your other question, every scenario, it's not every scenario. What it means is prepare for every scenario. It's just code for prepare for a no deal hard exit come the end of the year. But I just don't think that's going to happen, because the last thing any economy wants at the moment is to make their situation worse through a political own goal. And a political own goal would be both sides of the channel with economies that benefit by trading with each other, not trading. Stupid. It's just stupid. So I don't think it's going to happen. And in the same way that everybody thought, there would be a no-deal hard exit coming out, it didn't happen. We got there in the end because common sense generally prevails.
Well, we've got time to keep an eye on the commentary, Gary, and I'm sure these next 6 months are going to fly by.
One thing, Leo, I can tell you, everybody's obviously thinking that the pandemic's getting a lot better because they've raised the Brexit issue again. Nobody was thinking about this in April, and here we go again. I don't know what I dislike talking about more, coronavirus or Brexit. It's pretty close.
God, all of it. Well, it's good to see that it's on the horizon, and hopefully we will soon be beyond it. Gary, that's everything for now. Thank you for the insight. Ladies and gentlemen, as ever, if you've any questions, please send them through and we'll put them to the right people. Gary, thank you very much. Talk to you soon.
Thanks, dear. Thanks. Good to chat.
And you. Take care.